Welcome to the 2024 Economic Depression and Preparation Channel. I'm your host, Tony. Thank you for joining me on this Monday, September 9th, 2024 edition. Please be sure to subscribe to this channel or hit the like button and the bell notification so you can be notified when the latest videos come out. Appreciate everyone's support, ladies and gentlemen. Thank you for your comments, insightful comments. Thank you for supporting this channel throughout the years. And we will continue to make interpretation of financial news as it becomes available in the U.S. market. So today, what's on the agenda? We're going to be talking briefly about this softer landing that many people believe is starting to be eroded for this economy in terms of the inflation, in terms of the job forecast is cooling down. We're also going to be talking about the recession indicators and if a quarter point basis rate cut, is that enough? Will that be enough to sustain us out of a recession coming up next year? And how many cuts are going to be necessary to get us into a more favorable economic growth picture like the rest of the world and the eastern side is experiencing, some other countries are experiencing. So we're going to get into that. Thank you for joining me once again here. So the first article here is from BNN Bloomberg here. And they're talking about this U.S. growth forecast, quote, softer than forecast here. U.S. job growth forecast is softer than forecast. This is from BNN Bloomberg. And it's from out of Canada, I believe. But they're showing here that the car production values, the volumes here, they're showing that it's falling behind. The Euro area is falling behind in the European area, as you can see here. So, but who's going to buy? Who are buying these expensive cars when, you know, you're talking about payments lasting for 6, 7, or even 8 years in some cases on some of these trucks, when the jobs, good high-paying jobs are dwindling in the U.S. and the Eurozone and other markets as well. Even China's economy is cooling down, albeit not as much as our economy is cooling down. So the U.S. employers added fewer workers in August than forecast, and job growth in the prior 2 months was marked down. This is further evidence of a softening labor market that's fueling debate on how much the Federal Reserve should reduce interest rates. In other words, many are calling for above a 50-point basis cut in the next week or two coming up shortly here when they meet on September 17th and 18th. It's the next Federal Reserve Bankers meeting, FOMC, what they call it, the Federal Open Market Committee meeting. So, we're looking at a case now that hiring is slowing down here, and this is just not because we're getting closer to the end of the budget cycles in September and October and things of that nature for the year. Hiring is slowing down in more than one sector here, and this is really going to be interesting to see where do they go with this, because manufacturing activity also shrunk in August for a fifth month, reflecting faster rates of declines in order and production, declining orders, persistent retreat. And this also means that truckers on the road, on your interstate highways, if you look at that, you don't see much freight moving around as much as you used to. This is being reflected of that as well, according to supply chains here. So we're still dealing with technically supply chain shocks here, whether it be man-made or otherwise. We're dealing with that. So Volkswagen AG is considering factory closures in Germany for the first time in its 87-year history. So you can see here Volkswagen is considering Germany. They're closing down some of these plants here. They're scrapping some plants here, whether it due to automation or whatever the case may be. Layoffs are happening all around the world. And this is going to be very interesting to see what happens. Jobs reports as a boom for migrants, a slump for Americans. This was on Fox Business. AOL.com reports here in conjunction with Fox Business. The new August jobs report shows employment numbers of U.S.-born workers and foreign-born workers going in two very different trajectories. And you know, on my channel, we've been talking about that, how the replacement, the new technocratic economy is replacing with everything with automation and AI, and as well as immigrant workers not from U.S.-born. This has been happening for quite some time now, and now this is the replacement is going to be complete in the next 4 to 5 years here, guaranteed. So data released by the Bureau of Labor Statistics, an arm of the Department of Labor, shows native-born Americans lost more than 1.3 million jobs over the last 12 months. This is over the last year, while foreign-born workers gained over more than 1.2 million jobs. And obviously, you know, they're willing to do jobs that a lot of Americans are not. They're being paid less, as you know, and this is a big bonus for big-time corporations and monopoly oligarchy corporations here. So the news comes as U.S. job growth picked up in August but missed economists' expectations, while the unemployment rate changed little. So we have a situation here where more foreign-born workers are being hired here, as you can see, in construction, as you've all known that, in landscaping and hospitality at hotels, and even, you know, teaching assignments. Some of these rural districts are hiring contract foreign workers that they can get in for less money, don't have to pay benefits, and they all live, you know, 10 and 12 people to a rented Airbnb or a hotel, extended stay hotel, and they can pay them less and get more work out of them, quote unquote, than they can with a native-born U.S. worker, so to speak. But the figures do not differentiate. It's important to note, this says here, the article says, the figures do not differentiate between foreign-born workers who entered the country with authorization, meaning green card holders, and those with visas, versus those who entered without prior authorization. But in any event, it doesn't really matter, because the bottom line is that the companies are looking for the cheapest labor possible, and this has always been the case. You know this since the 70s, the late early 80s, and up into the 90s. It's been the case that, so the U.S. has witnessed a surge of immigrants under the Biden-Harris administration that we all know. And there's been more than 9 million immigrants, at least officially, on the books since the end of 2020. So here we go again. We're going to be seeing more jobs added, but not more made in USA jobs. It's going to be foreign-born jobs and things of that nature. So the recession indicator continues to flash here, according to Business Insider. A recession indicator with a perfect track record has started flashing this week. The yield curve, as all you know, is going to continue to invert. This may suggest that an economic recession may be near. And I think 2025 is going to be a year that's going to be very, very hard on the U.S. economy, because all of the stimulus money, all of the money that's, pumped into this economy, the helicopter money, even if they start quantitative easing and lower rates, it's going to be too little too late. And that's why 2025 is going to be a hard year, a slow year. The 10-year U.S. Treasury yield was about 3.757% on Friday afternoon. The 2-year yield was at 3.66. The yield curve has flip-flopped between positive and negative energy. So you can see here, de-inversion has preceded recession every time. In other words, this is an indicator, a strong indicator, according to the stats here. The U.S. economy, the shaded gray bars represent when the U.S. was in a recession. The last recession was in 2018, they say 2019, and now we're starting to uptick a little bit, getting close to that point here where we're going back up into that recession territory, as you can see, according to the investors. So the ultimate question for investors is whether the current yield curve disinversion will be sustained, or if the interest rate volatility picks up and the spread between short-term and long-term bonds goes back into negative territory. Either way, investors are selling first and asking questions later. So the sell-offs here is going to continue, and you can see that once they get more of these job reports saying that we're going to have numbers below, look, we only added 142,000 jobs last month in August. This month is going to be even less than that. This is below estimates. You can see there's going to be more sell-offs in this economy. So the Fed must decide if quarter point cut will be enough for workers. It won't be enough. I just tell you straight up, it's not going to be enough. They're going to have to go with either a 50 or a 75 point basis cut to even have a chance of making some type of dent in this inflation, or even in this job losses will continue. So the Dow Jones is above 40,000 for the moment. That's going to change next week as we go into next week here. But you can see inflation is rising, PCE inflation. Unemployment is holding steady for now, but you can see that it wants to slowly trend up too as well. The only reason unemployment is holding steady because they're getting a lot of contract workers and different things, short-term, part-time workers, and that's holding up the numbers right now. So bottom line is, ladies and gentlemen, we expect the rate cut to come September 18th, 19th. Will it be 50 or 75 basis point? No, they'll probably go with a 25 basis rate cut, which won't do much to quell this inflation. It won't do much to drop prices. It won't do much to stop the hiring freezes or unemployment that's happening in many sectors of the economy. And that just means that we're just going to prepare even more so than what we did previously in other times. So be blessed, stay prepared as we kick off this week. And I'll talk to you very soon once we get the earnings and the reports coming out on Tuesday and Wednesday. God bless. Thank you for listening. Take care.